Welcome, Mr. Lavi. First of all, really appreciate you accepting to be a guest speaker today and take all of us through to this new topic which has come to the fore. Right. I must, share a little bit about Mr. Mohan Lavi. So he is a chartered accountant from India. Of course, along with that, he has undertaken a lot of certification and courses and learning projects in his own way over his, educational and professional life spanning across 35 odd years, putting everything together. And that might be also on the lower side from his experience perspective. From his career credentials perspective, he started off his journey in the corporate world. Over next few years, when he was in the industry, he moved up the ranks in terms of his role, in terms of the breadth of the functions and the skill sets which he gained. And then he moved over to the other side of the table. He started practicing what he learned in the industry and through the books and the project. So he is now a practicing chartered accountant in India. That's from his career perspective. It's a reputed firm. It has quite a lot of partners and staff. So I think you can certainly look up Mr. Lavi's profile and know more about his current role. Taking forward in terms of the exposure he has gained as a finance professional. So he is certainly an expert and a renowned faculty around the international accounting standards and GST. So he has had a long tenure around writing books, delivering lectures, participating in different forums, and representing various authorities and organizations over the period. And sir, please correct me if I have mentioned anything wrong or incomplete. The list is endless, so I'm just short of words more than anything else. But not taking everyone's more time, I would request Mr. Lavi to please come forward, share a little bit about the topic today, and then help us, shape this webinar. Welcome, sir.
Absolutely. Thank you, Vineet. Thank you so much for that extremely long introduction, not short, but it was a long introduction. I'm not
I
sure
just
I
couldn't
deserve.
stop, sir, honestly.
I'm not sure I deserve so many things what you said, but I guess yeah, I think that's how it should normally start also. And anyway, so thank you, Vineet, for calling me here for this webinar. And just to tell the remaining participants what happened, this happened over the last almost about 4 or 5 days. This development of this meeting. So we met through a common friend, and Vineet immediately contacted me and said, "Can you do this?" And we were wondering what topic to do. And then we suddenly thought, "Oh, why not? This has just come the previous day, so why not we talk about this?" And so that's why we are here. So to all of you who joined in, thank you so much for joining in this program on this. Global international tax, so you can call it by different names if you want, right? So the first thing which I thought I will do is that I will give you a little bit of a background about this entire international taxation scenario, and then get into the actual whatever they call these two pillars of this proposal. I should also put out a disclaimer right away saying that many of these, the nitty-gritty of the schemes are yet to be worked out. This is just only a proposal as of now. There are a lot of things in the scheme are yet to be worked out. There's going to be a lot of negotiation with domestic jurisdictions. They will have to keep talking about what the tax treaties say. Some treaties may have to be amended also. So there is a lot of work still to be done. But the direction in which it is moving is probably on the right path, if you want me to use that word. If you want me to use that word, it's probably in the right path. So I think that's a disclaimer I wanted to give right now. So they call it as a 15% minimum tax. They call it as by different names. It's just that it's showing a particular direction to how this entire global international tax, as it is called, is going to be framed. There is a background to this, which I thought I will tell you all about this background so that you understand why this is coming in also, right? Now,
Vineet here, I just wanted to, I'm sorry to interfere. just want to say that if you are okay, could we take everyone's questions at the end, or would you mind if someone have quick queries and they really want to get a perspective being shared?
Preferably at the end.
All right,
Preferably at the
we'll do
end.
that.
I'll take about 35, 40 minutes. That's all we need. So then they can always ask the questions.
Please
But if
carry on.
somebody has to leave and has got a question, they can always raise their hand and ask the question. I'll put it that way. But it's only about 35, 40 minutes. So I think that we would prefer to take it at the end so that it all comes together, right?
For that, please carry on.
All right. So I thought I should give you the background behind this, because the Organization of Economic Cooperation and Development, so-called the OECD, has been in this game from 2013. They've been trying to do this, some sort of a base erosion profit sharing norms, right from 2013 onwards. And they've had 15 action points which they framed in 2013 for ensuring that the very reason why it was called the BEPS project was because base erosion and profit sharing, which means that countries were wanting to protect the base taxes, that is the taxes in the regions in which they operate. A lot of these pillars kept coming in different forms, and individual jurisdictions started putting their own taxes, and but it was a little bit no uniformity was given to it across many jurisdictions. This, what we are seeing today, is probably the first attempt to get a common platform for this digital levy. This is only for the digital levy, which could probably be one of the pillars of the OECD norms there. The other aspect which we should also think about, and I can probably, all of you all will probably also agree with me that this has come to such a state only because of the push given by the US government recently. It would probably never have reached this stage if not for the push given by the US government. So they really pushed this across, because individual jurisdictions were probably happy with what we're doing today in terms of international taxation. I'll come to that in a little bit of time, but the Janet Yellen and other people really pushed this across and saw that this particular thing got into a sort of they got into a frame of mind to push this across and take the first steps forward. They're still very, very, small steps. I can probably call them baby steps, but at least take the first steps forward towards this thing. I think the more important question we have to address today, and I think that will be a good part of my discussion, is that why is this required in the first place? We will then go down to the individual proposals. I will probably share the OECD summary itself with you all so that we can go through it in detail, in as much of detail as possible. Now, many of you would have probably also heard about this double Irish with Dutch sandwich and all these terms which are being used for many of these multinational companies operating in different jurisdictions. And the idea behind this was that it could technically be called tax planning. It could technically be called tax planning or tax strategization, in which they were making use of the intellectual property rights they had, or let us say an iPhone, or let us say a software, to ensure that taxes are being paid at the lowest possible rate. At the lowest possible rate. And we would have heard stories about news about how Apple got into some issues with the Irish government, and probably other countries also have got these individual jurisdictions yet. If you asked me if they were doing anything wrong, as per the law, they were actually not doing anything wrong. They were just transferring intangible assets to certain jurisdictions in a certain manner and ensuring that they were paying taxes at the lowest possible rate. Whether those countries which were operating, sort of really helped them to do this is a completely different matter. But there was a certain, obviously, arrangement also which was made. The problem in this happened also because of the fact that if you look at the transfer pricing norms today, which probably comprises a lot of jurisdictions have these transfer pricing norms. Though the transfer pricing norms to a certain extent tried to push a certain amount of profits in local jurisdictions, it has ended up in a lot of litigation. Because what is the exact arm's length price? Is the arm's length price correct? What are the adjustments we have to make? a lot of such issues has ended up in litigation. I can just give you all a very small example, which is happening even today as we are speaking. I am in India. I am a director in a company which is based out of Canada, and they have a very small operation in Bangalore. They have a 30 people operation in Bangalore, and it's only basically employees cost and some employees who are actually not doing software development as such, but just doing a certain amount of work for the Canadian holding company. Now, when the transfer pricing things had to apply, we were told that it should be a minimum of cost plus 15%. Now, nobody told us what this 15%, what was the basis for this 15%. If you asked me for an equivalent company, we did not have one. A company with 30 people operating in Bangalore with such a low revenue probably did not exist in. So when we went across the filters in this transfer pricing process, we found a lot of companies we had to eliminate. The companies we eliminated incidentally, which were almost probably similar to this company I'm talking about, had a much lower profit rate. Some also were incurred in losses. So this became a problem in the transfer pricing regime. So we had to buy this, piece with the income tax department because of the fact that we were told that this is what companies normally charge. But when I looked at the transfer pricing rates given by comparable companies, I found that even large enterprises were having a similar profit margin. Extremely large enterprises, probably not the same in size as what we were talking about, had a, if not lesser, similar profit margin. OECD has always been saying that there should be a certain minimum levy which has to be kept in the respective jurisdiction, irrespective of what you have got in terms of, whether you want to shift the money outside, whether it's IP rights, whether it is, they've always been maintaining that a certain amount of taxes will have to be maintained or will have to be retained in the respective jurisdiction. Now, whether this is in the form of a transfer pricing thing, or whether it's because whether talks from treaty benefits have to be given, that is something which probably we can decide. I mean, individual jurisdictions will have to probably decide here. So the problem also became that once the OECD project commenced in 2013 and started putting out this digital levy and all these things, individual countries started taking that as a basis to levy some sort of taxes. Again, I can tell you from the point of view of India, levied something called as equalization levy. They brought in something called as an equalization levy in 2016, which was basically supposed to be for online advertising, and later has now been pushed on to also include things like e-commerce services being provided. For example, if you put a job alert on LinkedIn, it could technically meet the definition of a e-commerce service and be subject to this equalization levy of 6%. So what has happened now is that individual jurisdictions have taken this problem of international taxation on this BEPS project and started levying this 6% tax or 7% tax at different rates. It has been the attempt of the OECD all along to ensure that we should not probably be calling it as a global tax as such, or global single rate of tax, but I think we should probably call it as a platform to levy a uniform rate of tax. The rate of tax is going to be the minimum. It will change between individual jurisdictions. It's not going to be a 15% rate. 15% is the minimum rate. A little bit of a flexibility given to jurisdictions to levy a certain amount of individual taxes. So this was the background. So the background behind this was issues in transfer pricing, not ensuring that profit stayed in the country, not ensuring that profit stayed in individual jurisdiction or in individual country. A lot of litigation on international taxation, especially in transfer pricing. This has prompted the OECD to push it along with a few countries to come with this particular project and say that we will now try to attempt, at least make an attempt to ensure that a certain minimum levy is put so that these issues are sort of sorted. So this was the background behind this. Of course, when this, I should also tell you all that when this Irish sandwich, which I told you all about, came to the notice of the OECD, They gave all these companies a 5-year time frame and told them that by 2020, you all should stop all these, let me technically say it's only tax planning. I won't call it as tax avoidance or tax, evasion. I'll just call it as tax. So 2020 was when they were supposed to stop, and this is coming in 2021. There's an obvious connect between these two. There's an obvious connect between these two in that they wanted this to ensure that once those things happened, this new thing would probably come into play. Of course, courtesy of the lockdown and all what has happened, probably there's been a little bit of a delay. But now, assuming that, nothing major happens again in the future, we can expect that these new provisions, which we just discussed now, are going to go forward. And probably, by 2023, they are expecting this digital levy to come in place. The timeline appears to be that they want to put in a few of these, work out the modalities by now, October of this year. And later on, give individual jurisdictions a little bit of leeway to decide what to do with their individual treaties. And then come out with this, probably ensuring this comes in 2023. I will still go and say that it is early days. A lot of work needs to be done. A lot of countries have still not signed on. What we are seeing today is 130 countries have signed on, but countries like, Ireland itself has got its own reservations on this. Hungary, Estonia, Nigeria, Kenya, many of these countries have still
What about
not.
UK, sir?
UK has signed, unfortunately. Ireland has not signed. So Barbados, for example, has also not signed. Now, we all know this from history. We know this from history that if I have one tax haven in one jurisdiction, that's all that's all a company needs.
Yeah.
And we're talking about all these top 100 companies. It's not going to take a lot of time for them to set up in a new jurisdiction at all. It's not going to take much of time for them at all. I think the challenge for the OECD would be to how do you get these countries also onto the, this particular platform, if I may call it so, and ensure that they also are on board. Because a very interesting decision which has not been published, incidentally, this has not been published, but this is an Australian decision which came out upon this Irish, this sandwich I told you about, this tax planning for the IP and all. The Australian High Court has held that it is a legally permissible arrangement. They did not want to publicize this too much because then everybody will say, okay, this is anyhow legally permissible, we might as well take it on board. But it was a sort of a private thing which was asked, some sort of an opinion sort of a thing which was asked. So they said that this is nothing wrong with this because you have got arrangements in place. You have ensured that within the four corners of the individual laws, you are trying to pay those taxes which are possible. And a certain amount of taxes are already also being paid here. So I think this is the challenge. So as I said, these are early days yet. We will still see a lot of action in this. But I will repeat what I said earlier. At least it shows that there is a direction involved. Never before in the history of international taxation, never before have so many countries come together at one point to sign on a single document like this. It has probably never happened. They have left the individual jurisdictions to do what they want, but never before it has happened, that all these people come together and say, okay, we're going to sort of, sign on this document. So that effort itself is probably something which is very much to be appreciated, and also something which I think is very unique to ensure that this thing will go forward, right? So I've been given this screen sharing, right? So what I'm going to do now quickly is that, so again, I'm going to put one more disclaimer here. And that disclaimer is that some of these provisions, I'm just going to run through it in a very, like a helicopter sort of a view, but some of these may sound slightly complicated. I'll put it that way, slightly complicated, but we will come and, we look at the individual details here. So basically what they have said is that there are going to be two pillars here. There are going to be two pillars in this entire scheme of things. The first pillar would apply to only what the OECD says are the top 100 companies internationally, and they have defined it to be with a global turnover about $20 billion and a profit about 10%. So this is why they have said that it will apply to the top 100 companies only, who are obviously operating in multinational jurisdictions here. Exclusion has been given for extractive industries like minerals, for example. Regulated financial services, they have also been excluded from this particular, pillar one scope itself. There's an exclusion here. And they've also said that after 7 years, they will review this to see if other companies with a lower threshold can also come into this. So 11 years is a pretty long time, but they're going to review this after 7 years to see that, this, if possible, they will, include other companies also. The entire, this entire pillar one is resting on this nexus, right? This nexus rule. The nexus rule is what is going to decide this entire pillar one. It says that the multinational enterprise, 1 million euros in revenue from that jurisdiction, they're going to put a nexus. So you can call it as the nexus will be between the profits in that particular jurisdiction as as a percentage of the turnover, as we have seen here. And they have also linked it with the 20 to 30% of the residual profit, defined as profit in excess of 10%, will be allocated to market jurisdiction with revenue. So once you have the nexus which has been set up, what they are saying is that if I am, let us say, a Google operating in India, if I'm a Google operating in India, I meet this nexus rule, obviously, because I've got this 25 billion euros, 20 billion euros, and all these things. Excess of 10% of revenue, profit. So if my revenue is of $100 million, 10% of that, 20 to 30% of profit will be allocated to the jurisdiction, which means that basically 20% of that 10 crores or whatever that figure is will be allocated to that individual jurisdiction. A very important change here, which we should note, is that this has been based on the revenue and not on the profit. The nexus is based on this thing. So this is based on the revenue here. And the revenue in the nexus, as we have seen, the quantum here is based on the 10% of revenue. So obviously what is going to happen is that your numerator is going to go higher. Your numerator is going to go higher. So there is going to be a certain amount of probably better amount of tax which will probably come in here. This is the quantum. This is not the tax rate. This is the quantum. Individual tax rates will be fixed for this particular item. So they're going to put in this nexus with the criteria of turnover, 10% of revenue. Out of that excess of 10% of revenue, 20 to 30% will be given as the taxable amount in that particular jurisdiction. And they will probably levy a certain tax rate for this. That will obviously be negotiated between this thing here. So a quick question which many of you all will probably be having is, what happens to my transfer pricing? Transfer pricing goes into pillar 2. Transfer pricing goes into pillar 2. This is only for that those top 100 enterprises. They will anyhow come into the pillar 2 by default, but the transfer pricing adjustments will come in there. So it will not come into your pillar 1 here. Pillar 1 is only to ensure that you get this minimum sort of base for the revenue here, right? And of course, they have talked about the taxable base and or what will be the tax base. The tax base will be based on the accounting standards and all they have said here. We really should not get into too much of a discussion about what accounting standards will apply. Hopefully, it will probably be IFRS only, because that seems to be the global norm for accounting standards. But again, in case there's a US GAAP entity, what happens if there are differences between US GAAP and IFRS? So there's going to be a common, a reconciliation will have to be done. All these things are matters which yet have to be sorted out. But let us assume that the differences are not very. For example, I can tell you in terms of accounting standards per se, the US GAAP permits the FIFO method, the LIFO method for inventory valuation. IFRS does not permit it. So what will happen? Those are a lot of nitty-gritty details which you'll have to look into, because that is something which individual jurisdictions will have to probably determine here. Now that we have the tax base, and we're probably going to have a tax rate also, which will probably come in here, they have also given one small scope here for what is called as this transfer pricing, which I told you about. This is called a safe harbor for marketing and distribution profits. Only we should remember that this is only for the marketing and distribution profits. In case there are certain marketing and distribution profits which are already being taxed, they will be given a safe harbor, which means basically safe harbor means that they will ensure that a certain amount of deduction is given for that, and there will not be a top-up levy on top of this because of this pillar 1 there, right? And they have also mentioned that there will be an elimination of double taxation. I mean, which means that the same amount will not be taxed again. So for all practical purposes, what would happen in this pillar 1 is that since my base or the quantum has already been ascertained based on a number of revenue, the excess of profit, right? That quantum has already been arrived at. Let us say it is X amount of money. The tax rate hopefully will be, let us say 15%, because everyone is talking about this 15% as the rate. On that tax rate, I'll be paying a 15% tax. So this is my basic amount A, is what they're talking about here. What will happen for my individual items, like what I'm already paying in the local jurisdiction? What will happen? Do I get a credit? Will my tax treaty come in the way of this particular thing? These are questions which should have to be probably looked at. The safe harbor is only for the marketing and distribution profits, not for other transfer pricing adjustments which will be required. And they've also mentioned that there will be a double taxation of profit will be relieved using the credit method. That means that in case it's already been taxed once, they'll give a credit for this particular thing. But the one clause which is probably of some help is the fact that they are talking about this dispute prevention and resolution mechanism. This is something which is probably very, very critical to this entire scheme coming out successfully in any jurisdiction. Now, we know for a fact that as I have already mentioned to you all, litigation is there. Litigation is existing even today in the international taxation sphere. We don't expect too much of litigation in pillar 1 because my numerator is almost ascertained. The litigation can come. What happens to what I've already been paying on, or how does this mechanism of credit work? Will my transfer pricing overpower the pillar 1, or will it be a mix of both? All these are things which will have to be settled here, for which we thought that the tax certainty clause is an extremely important insertion in this OECD norms. It was there, if you can probably go back to the first original OECD document which came up in 2013, they had a clause for tax certainty. But for whatever reason, they could not implement it, or they were probably busy doing those action points, so to speak. So they could not, let us say, administer this tax certainty clause very, very clearly. Now, so this is as far as this thing is concerned. They have also, so the amount A will be your what you can call as your the numerator, so to speak here. And now they have said that they will talk about amount B, which will be application of arm's length principle and unilateral measures will be given for administration, all these things. So this we really did not worry about, because this is where the adjustments will come in. Here. And they are talking about the multilateral instrument to which it will come into place here. And they've also mentioned the timelines of 2020 to 2023. I think the best way to explain this would be by way of an example. I thought instead of just looking at this entire, these various norms here and look at it. Let us say that Google is operating in India. I'm giving the Indian example because I think it will relate to a lot of people who are here, especially to relate to Vineet more importantly. So I thought it's better to give an Indian example. They are paying, let us say, a cost plus 17%. 17% is what they are paying. Now, when I'm saying cost plus 17%, I'm saying this is the amount of their transfer pricing price. So they're obviously charging this amount to Google in, let us say, USA. That comes in their revenue. And there's obviously going to be a certain expenditure which is going to be given, and they'll probably pay a tax in the net amount here. Since Google will definitely meet this initial criteria, what they'll have to worry about most is that 10% of revenue in India, between 20 and 30% of that profit in excess of that would be your tax base, for them, on which a particular tax will have to be applied, As I said, let us assume there's going to be 15%, because everyone seems to be thinking that it's going to be taxed only at 15%. The accounting and all those things will not worry about too much, but whether there's going to be a transfer pricing adjustment because of a low tax jurisdiction will not worry about those individual nitty-gritties, because I'm assuming that this will overpower all those things. This will overpower all. This is an assumption which I'm making. So that this is what has been fixed as far as the Google thing is concerned. So the most important part in pillar 1 is the threshold of revenue, which is what is given here. This 250,000 euros, and they've also linked it to the GDP also and said that if it's 1 billion euros first and then 240 billion euros. So, I mean, a lot of this GDP based thing also is there. But I am sure that the GDP has come only because it's from the OECD, not for any other purpose, because I think the OECD is very keen on this GDP concept here. So this is as far as your pillar 1 is concerned. If you look at again, a little bit of what you can say, sort of I won't say warning, but sort of a disclaimer again saying that this is slightly more getting into what the domestic entities will have to do, or domestic jurisdictions in tax will have to do. This is not about the thumb rule of what you can say, turnover, profits, and all those things. This is talking about completely domestic based. What individual entities or individual jurisdictions will have to do to ensure that this is in place. So you don't worry about the terms and all. As I said, this is still early days yet. But basically what they are talking about here is that there are going to be interlocking domestic rules. There are going to be some domestic rules which are going to be imposed in place. The most interesting part of this is that they have said that a top tax on a parent entity in respect of the low taxed income of a constituent entity. I will not take you all beyond this, because it is assuming that there's a low tax which is being paid in a particular jurisdiction. They are going to add a top-up tax on top of this. This is not the only thing. They're also going to add on to this and saying that there is also going to be an undertaxed payment rule which denies deductions or requires an equivalent adjustment to the extent the low tax income of a constituent is not subject to tax at all. We cannot show a nil tax. There has to be a minimum tax which has to be paid here. So it's like, what the alternate minimum tax which has to be paid here. So this is one part of this domestic interlocking rules. I think many of you would have, people who have participated would have obviously seen this saying that, IP rights, royalty paid, and my total income is $100 million and my royalty paid is $95 million. So, I am effectively paying tax only the $5 million. That will not happen in this situation, because it will definitely fall under this undertax payment rule. So you will not be able to show a very low tax. And they'll, if I'm not mistaken, the OECD is trying to give industry specific rates, which is going to be a huge project of them. Industry specific minimum rates they're trying to give. So if you're in software, you can't go below 15%. You can't go below 20%. I believe that this is a thing which is going to come in. And of course, they have something called for currency adjustment also. This is something which the OECD is obviously working on, but they will definitely get there, because the idea is to ensure that, as I said, the entire idea behind this to ensure that if it is US retains a certain profit. If it is India, we retain a certain percent of the profit. If you look at the next part, this becomes slightly more difficult to interpret, again, not implement, I would probably say. Now they are talking about a treaty-based rule that allows the source jurisdictions to impose limited source taxation on certain related party payments subject to below a minimum rate. You look at all the adjustments which you spoke about. You talk about Apple, you talk about Google, you talk about LinkedIn, you talk about anybody. All the payments are made to related parties only. All their payments for royalty, IP rights, wherever they try to minimize the tax, so to speak, were paid to related parties only. So what this pillar 2 is doing now effectively is that they are saying that if we have a certain, if pillar 1 was the numerator, this is the denominator now. The denominator is going to be a situation wherein if you have got a certain low tax, they're going to be put in a top-up tax on top of it. certain deductions may not be permitted or will not be allowed for you. On top of it, they say that related party transactions, they can allow a limited source taxation. If you ask me, the second portion, the related party transactions, is going to be a problematical area. It's going to be a problematical area because as it is, the problem of arms length price is complicated. On top of it, if we're going to put a taxation subject for that, it's going to be even more difficult if you ask me. Yeah, Vinit, you're saying something?
No, no, it's okay. I'm just saying, yes, you're right.
Yeah. Okay. So now, if you look at this thing, now they are talking about these rules will apply to multinational enterprises, 750 million euros threshold under BEPS Section 13. BEPS Section 13 is basically country by country reporting. Individual countries will have to report, CBC reporting was called here. And they are free to apply this to MNCs headquartered there, even if they do not meet the threshold. Now, here they are talking about this minimum tax. I will go down here without worrying about this. They're talking about the minimum tax of 15% here. They're saying that the reason why this has been called as the minimum tax is that because they have said that it is in the second pillar, they said that it will be at least 15%. So you can imagine this again, what is going to happen. Suppose an entity in India has been paying, let us say, 12% tax. They will now pay 15%. The approach, the amounts on which the tax is obviously going to be paid will probably differ here. But by imposing this 15% rule, they're going to ensure that these low tax royalty payments, payments to related parties, trying to get a deduction because of a payment to related party, all those things will probably be slightly avoided, or at least it will be minimized. Also they are talking about this 5% of the carrying value of tangible assets and payroll will be excluded from this. They're going to give a certain carve out for this. And they've also mentioned that international shipping income, that's okay, it doesn't matter. I think I thought I'd tell you one important part of this. Yeah. They've said that yeah. It is agreed that the Pillar 2 will apply a minimum rate on a jurisdiction basis. In that context, consideration will be given to the conditions under which the US coexist to the global to ensure level playing field. So this, what you can call as the Pillar 2 is, as I said, completely left to the individual jurisdiction to look at it from the point of view of what the OECD also is saying. A large number of the middle enterprises, so not so-called not top 100 companies, would get hit by this Pillar 2, if you ask me. Pillar 1, definitely 100 top 100 companies. Pillar 2, a lot of these other companies would probably get hit there. The challenge in this Pillar 2 is that because it is touching the domestic, speak about domestic rules, it is talking about what the domestic taxation says for this, for these enterprises here. Say, for example, your 6% equalization levy will now go away and it will become 15%. The amount on which the 15% is calculated will probably be slightly different, but it will still be 15%. That will be your minimum rule here. India has the option to make it 17%, 18%, 20% also. So the entire scheme of both this Pillar 1 and Pillar 2 has been structured in such a manner that the sub 10% rate of taxes do not exist any longer. They will not exist any longer, irrespective of whatever tax planning you're trying to do. I mean, because they have, you can just look at this from a very holistic scenario. What has happened is that they have ensured that all the related party payments will suffer a certain amount of tax. That they have said very, very clearly. They'll put in case they feel that your transfer pricing is less, they can put in a top-up tax. That also they have plugged here. So you can see that in overall, what you can say, context, because the rate is higher, numerator is higher, threshold is higher, there will be certainly an expectation that income also, or taxation income also, is going to be high. I will not get into too much of a detail about the other parts of the scheme, because as I said, a lot of threads still need to be ironed out. But I can only look at the challenges here. And we can probably think of the fact that, so to me personally, the last 7 years of how the OECD has approached this entire BEPS project is definitely commendable, But whether it will work in 139 jurisdictions is something which is really going to be a problem, cause for concern. I would personally feel that, because individual jurisdictions would need to think whether they would really fall for this completely, or they want to, uh, do this in a different way. For example, I can tell you all that when the US said top 100 companies, India said, no, we'll make it a lower threshold. So more companies are, in this tax net. So what is happening basically is that every country wants to extract the maximum pound of flesh from this international taxation. Whether these laws permit them to do it or not is something which we really will have to think about very seriously, because with a higher rate of tax and with a higher threshold, so to speak, of income on which the tax is based, there is definitely going to be at least mathematically speaking, there should be a higher income for the government also. But we have seen also in countries like Netherlands, for example, they've also had reservations with the OECD on some of these aspects of this taxation. They said you should give us certain freedom to levy a certain local levy, which is taxing enterprises at a certain rate over and above this, whatever you're talking about, the minimum rate. Even this was recorded in the meeting of this OECD also recently, the objections given by other countries also. With this situation coming into play now, whether this was going to be, see, as I said earlier, this is a very good first step forward. And what gives me the confidence that this will be pulled off is the fact that the OECD has been on this for the last 10 years, consistently. This appears to be the only task of the OECD. They don't seem to think of anything else. They've been doing it in bits and pieces, agreed. Some challenges have come up in local jurisdictions, but they've been at it completely. My bigger concern is going to be the smaller countries who do not have too much of, let us say, so-called international transactions, so-called international enterprises residing in them or working there. Like, for example, we can talk about there's a jurisdiction called as Saint Vincent, which is basically only nothing but tax haven, right? They don't have any companies which are operating there. They don't have too many Apples and Googles which are operating there. If these countries don't get onto this bandwagon, and I don't see any reason in the present laws why they should, because they are going to say, look, we're going to be happy with our taxation laws. If Google wants to come and set up an enterprise, let them come and set it up here, no problem. They still don't pay any tax. That's how we are, organized, and that's why we don't want to get out of this situation, at least. But as I said, for example, Kenya also is a country which, though technically speaking, cannot be called as a tax haven. Kenya has said that we are nowhere near international taxation. We are happy with our domestic taxation. Let's not even get into this business of talking about internet. They didn't even want to sign up this agreement because they said this is nowhere what we are going to tax our enterprises. We will levy a domestic tax. It will be applicable to all enterprises operating in Kenya who are registered in Kenya. Whether they have got transactions with related parties or not is not our botheration. So to me, I think that would be the biggest challenge in this entire scheme of things. But I would feel that at least courtesy of this project, a couple of things are definitely going to happen. One is that the so-called payments of royalty to save taxes would definitely reduce. I will not necessarily royalty, IP rights basically. Paying off IP rights to related parties just for the purpose of saving taxes, setting up multiple enterprises in the same jurisdiction. I think that will definitely reduce because of the fact that this top-up tax is definitely going to be a concern for them. And also the fact that, there is going to be a certain minimum tax which is going to be levied on that. So that will definitely reduce. So I think that is a very big plus for enterprises. But in the same breath, before I conclude, I'll say that tax managers, tax accountants are all paid to innovate. They're all paid to innovate. There is no reason why they should not already be thinking of a scheme to get away from this thing. There's absolutely no reason why to think that, why they should not think of a scheme to get away from this, or to at least when I'm saying get away, I'm not talking about avoidance. I'm still talking about tax planning only. I'm still talking about tax planning. There's no reason why they should probably think of a way to, circumvent these rules and still ensure that, taxes are paid at a minimum, or at least minimum taxes are paid in individual jurisdictions. So that's what I wanted to tell all of you all about. I have not given a PowerPoint presentation. I have just followed what the OECD has told you all. As I said, this is only a helicopter view. A lot of things still needs to be done. A lot of things still need to be done. The next meeting is scheduled in October 2013. This is what we heard. The next meeting is supposed to be, 2021, not 2013. It's supposed to be held in October 2021, wherein they have said that they will come out with the exact details as to how this top-up tax would work, and what will be the permissible deductions. I think this is what is most important now. What would be the permissible deductions to be allowed against this particular top-up tax? So we await the further, instructions or further meeting from the OECD. So I thought I should tell you all only about these things. With this, I will hand it over to Vineet again, and will happily welcome any questions you all can ask.
Thank you so much, sir. This has been very insightful. I think first and foremost, it's a new treaty, new legislation. So, of course, not just a lot of gray areas, but a lot of things to be deliberated and clarified and agreed upon by all these stakeholders. And I'm sure only then it is going to come to professionals like us to even look at it from an implementation slash planning perspective.
Yeah, absolutely.
So I'll keep it open for everyone to share their thoughts.
So you need not
queries.
ask me questions. You can still have thoughts also. Please don't think of it as a question. You can have your thoughts also on this.
I have one question.
Yes, yeah.
Obviously, we don't know the full details of how this is going to work in practice. But looking into your crystal ball, do you reckon that if you say that this kind of like scheme or this kind of like tax treaty has been dreamt up to deal with the likes of kind of like Amazon and other companies who make billions of dollars and don't pay any taxes or very little, do you think it's going to work? Do you think they will end up paying their fair share of tax?
Okay, good question. The answer is, I don't think so. I think they will still come out, have their own schemes up their sleeves, right? But what will happen, Amar, is that because see, if you look at the provisions, they're trying to plug it from different ends. Okay, so there will be a certain amount which will be paid, which will be higher than what they're paying right now. It will certainly be higher than what they're paying right now, but there's going to be completely avoided. I don't think so. So they will have their own ways to get around this, but there'll be a little higher payout in terms of monetary. I mean, the quantitative amount, but definitely it will not be. They'll not be able to completely remove the tax. Yeah.
So what do you reckon is going to be the basis of whether this will be judged a success or a failure?
Good question. Again, very good question. I would think it would be the way the middle income, okay, let's say not middle income, but countries like India transition. I'm not saying this because I'm in India, but the reason I'm saying this is because the the need for a local levy has been felt so strongly, that whether our present laws are better than something which is being pushed in from the OECD. So if you ask me, like countries like India, China, these countries, whether if they are able to push this in successfully, I would think it to be a success, definitely.
And if I may ask, in general, because this is a law which is talking about levying the tax on like a top league of companies, will it be fair to say that only the top layer of the consultants slash tax planners are going to be involved in all of what is going on, what we will be hearing, and all of that? So let's say, I'll give you a different perspective. A professional like me, who would have more of a small sized companies, let's say MNCs companies, also maybe of $1 million, $10 million or $50 million kind of revenue. So a large chunk of professionals will be aloof from what's going on. Did I make it clear? Were you
Yeah,
able
you
to
made
understand?
you made it very, very clear. Absolutely no doubt about that. Yeah, I'll answer that in two bits, two parts, Vineet. One is, of course, that definitely, yeah, in terms of the compliance with this particular law as such. When I say compliance, I'm talking about applicability and all those things, calculation and trying to do the documentation, all these things.
Right.
We don't stand a chance. We don't stand a chance. And I'll be very upfront with you, very honest with you on that. I don't think we will be able to get because all these schemes have been invented only by those people, whatever we were talking about, right? So unless you come out with something really brilliant and sell it to them, we will not be able to. I think that initial piece of that cake will not be able to take. But later on, litigation aspect, I think there definitely you stand a chance, because those are the people who are not getting into litigation. So I've seen this happening in transfer pricing also, very much. I've seen this happening in transfer pricing also, right? They do the transfer pricing study and then they go away, they take their fees and go away, and then we do the litigation bit, So I'll think that initially the answer is no, but later on definitely yes.
Okay. Thanks for that.
I had just one follow-up question. I think quite a lot of countries have actually signed up to this treaty. I think it was, I don't know the total number, but I think it's over 100.
130.
130. What key countries have not signed up?
Yeah, the most important country which has not signed up is Ireland.
Okay.
Hungary has not signed up. Countries like Estonia, I told you, Nigeria, Kenya, they've not signed up. But the concern really is from Ireland, because a lot of focus has happened on Ireland because of this 12.5% tax.
Because Ireland, I think, is where, for example, Amazon, whether it's got its head office there or it is got a large corporate office running out of Ireland, mainly for tax avoidance purposes, I think. How would that work in practice then? If how would this treaty work if a country like Ireland, which big multinationals like Amazon used for tax avoidance purposes, are not a signatory to this agreement?
Yeah, so that's what I said. No, I think the concern definitely is the fact that Ireland has not signed up, because if you look at what is actually happening when these companies are transferring their IP rights to the royalty payments, I told you related parties, right? That is what they're trying to plug in this tax here. That's what the OECD is trying to plug, right? And Ireland has come out and said that if you are trying to tax that, we are not in for this game. You tax the total amount at 12.5%, we are okay with it. Ireland has always maintained that for a country of our stature or our presence, 12.5% is what we can charge. We don't want to get beyond that, right? So if those payments are curtailed because of this new law which has come into place or is proposed to be in place, I think Ireland would definitely not want to sign up. So the concern for me is definitely Ireland, Barbados to a certain extent, because certain portions of Barbados are considered to be tax havens. They give you an address which is a tax haven, right? So again, that is also a cause for concern, because, as I said, it'll take overnight for Amazon to go and set up an office in Barbados, or transfer rights there and get into agreements and all those things. So I would think that these two countries will probably be the most serious concern for me. Also, I think one thing, Amar, we should not forget also is the fact that what will happen in the subsequent negotiations? Will countries start demanding more of local, levies or higher rates, so to speak? We're not sure the OECD is going to agree for that, So we're not sure that they're going to agree for that particular thing. So a lot of work in progress still left to be done. But to answer your question directly, I think Ireland is a big, big concern. Because out of the top 100 companies, according to information given to me, at least 40, 50 companies have this sort of presence in Ireland, only for the 12.5% rate. Amazon has got it, Apple has got it, Google has got it, everybody's got it. I mean, Netflix also has recently set up in Ireland, I think. So that is really a concern, because they would still prefer to probably go there and get that benefit of the lower rate.
Is there a kind of...
Lavi, this might sound a little... Sorry, go ahead. Go ahead, Amar.
I was just going to say, is there any mechanism in the proposals to deal with the islands and the Barbados this world?
There are. So the top-up tax and the prevention of related party transactions, which I just spoke about, the pillar 2, that is going to prevent this thing. So basically what happens in this Apple and Amazon situation is that they set up two entities in Ireland. One is controlled in some other jurisdiction, which is a tax haven like Barbados or whatever it is. So that company does not pay any income tax because they're controlled by that Barbados company. The company which pays taxes or which is resident in Ireland, the normal company, gets a deduction for this royalty payments of 95%, which I told you about. So their profits are effectively 5% of turnover. That has been plugged in this particular proposal now. They're saying that we'll not allow you to do that deduction here. And impose a tax of 15% on the total, the revenue which is given there. Very clearly, it has been done only for the purpose of plugging those transactions.
So if you have companies like Google and Amazon that operate in, because this is aimed at multinational organizations, if they do the top-up tax, which jurisdiction would receive that top-up tax?
The local jurisdiction. So it would be, let us say, for example, if it's Ireland, it'll be in Ireland only.
But if the Irish government isn't part of this agreement, then how would that work?
No. If the Irish government is not a part of this agreement, they will not be a part of this agreement. They will not get this top. They will not be able to levy the top-up tax also.
So I don't understand how they've closed the loophole then.
That's why I said that's a concern. I said don't inform them, Amar, because
like a Brexit thing, if I may say. So UK all the time dilly-dallied, whether or not to to sign on to the Brexit and how to adhere to whatever terms and conditions were there as a part of Brexit. Ultimately, everything integrated and whatever has to be done is being done, right? Amar, just to answer if I'm correct, right? I mean, the perspective is that eventually people and countries and things will fall in line. So whosoever is required to be a part of this treaty.
And of course, as I said, I mean, the only way I can probably directly tell this is that give like that speech in Godfather, give Ireland an offer they cannot refuse. Right? Let us say you make Ireland an offer 20%. They're going to fall for it directly. A top-up tax of 7.5% over that 12.5%. So you should give them an offer they can't refuse. That's the only way you can get them to buy in this. Yeah, SK sir, you had a point, sir. You wanted to ask a question.
Yeah, no. I this might sound very naive, but to me, as a whole, this sounds more like a MAT, it's the minimum tax. And the question I had was, now suppose there is a local jurisdiction charges that 15%. Do they get a set off in their own parent jurisdiction against that, or an additional tax? Is there any
No.
clarity on that?
Yeah. So basically, what will happen is that this minimum tax will replace the 15%, right? This minimum tax will replace the transfer pricing norm, the local transfer pricing norms.
Okay.
But if you are, let us say, at a higher rate, let us say you're 20 to 22% because of the area or the industry you're in, it appears that there seems to be a situation to bring you back to the 15% threshold itself. So it works both ways. You will have a basic minimum, and you will any higher threshold, you can get a tax credit also. So it will go on the replacement principle. You won't have transfer pricing plus this particular thing.
Okay. It sounds very.
It is complex.
Fascinating.
It's quite difficult to implement, if you ask me, still. But a lot of efforts still have to be made to sort of get this into a proper shape, and get the buy-in of all these guys. There's a humongous amount of work which is involved in this. And of course, as Vineet was saying, I think in early days now, but only the big four consultants are going to be the top consultants are going to be the people who are most benefited by this right now, I think, because they still have to look at between the lines what this particular provision says and all those things. So there's a lot of work still involved in this. But I will still feel that this is a major event, because never before, as I said, never before has this really happened in such a way. So they seem to be very keen on this common purpose to ensure that this tax planning is stopped and local jurisdictions get a certain amount of levy. They seem to be very keen on that. The OECD is absolutely clear on that. But as we know, whether this will hurt individual jurisdictions more than others, these questions still have to be answered.